SK Hynix dropped 8.2%, and everyone is panicking. The company announced raising $26 million to fund next-gen memory fab expansion in the coming quarter for its HBM3 line. That $26 injection fuels capacity for 176-layer DRAM, tightening supply across its 300 mm wafer line, boosting yields. The Moat score is 64 out of 100, durable. Here's what the business evidence says. What operating evidence matters most for SK Hynix Inc.? Raising $26.5 billion in its offering at a $149 offer price across 177.9 million shares, the firm established significant capital balance to fund next-generation fab improvements. And another question, what could weaken SK Hynix Inc.'s Moat durability? With global demand for smartphones and laptops softening, unallocated standard memory risks flooding the spot market, applying severe pressure to overall gross margins at the exact point in the cycle where trailing P/E, price-to-earnings ratio, a metric comparing current share price to historical net income per share, stands at 20.8x against a forward P/E of 4.8x. Walk the AI stack, and SK Hynix sits as a Tier 1 bottleneck, controlling HBM leadership, 58% share. The moat here is oligopoly, and it should hold for medium. On the cycle, this layer sits at peak. The one force that could crack it, Samsung HBM reentry, Micron HBM ramp, drums cyclicality. Wall Street sees a classic late-cycle trap unfolding in real time. Investors are pricing in maximum capital intensity at the exact moment AI memory pricing power threatens to peak. The sell-off reflects immediate anxiety that aggressive capital expenditure will bleed cash balances long before next-generation capacity turns into high-margin revenue. With tech indexes sliding and beta sitting at an elevated 2.41, traders are dumping primary memory providers in favor of downstream beneficiaries who capture immediate value without bearing massive fab construction liabilities. Capital is rotating rapidly out of capital-heavy silicon foundries and upstream DRAM producers, fleeing toward asset-light architectural nodes. The consensus narrative is simple. SK Hynix is spending record capital at the exact top of the cycle, exposing its balance sheet to a sharp valuation contraction if customer demand cools before those multi-billion-dollar cleanrooms go operational. The market is panicking over fab expansion dollars, but the physical bottlenecks on the silicon floor tell a far more ruthless story. You cannot deliver those thermal and density tolerances without brand-new cleanrooms and advanced lithography tools. However, the hardware reality reveals a structural vulnerability that financial models are completely overlooking. SK Hynix's total DRAM revenue market share slipped from 29% to 26% in the second quarter of 2026, while Micron surged to 25%, closing the gap to a single percentage point. Quarterly financials showing modest revenue momentum for SK Hynix. Federal Reserve rate policy at 3.63% and a normalizing yield spread at a positive level are slamming high capital costs directly into SK Hynix's fab expansion plans. The macro environment is not a passive backdrop. It is a living, destructive wave. With 10-year Treasury yields sitting at 4.68%, the cost of financing physical silicon infrastructure has reached multi-year highs. On paper, the demand wave looks unstoppable. TSMC reported July revenue of 467.6 billion new Taiwan dollars, a massive year-over-year surge that serves as the premier leading indicator for hardware demand. Meanwhile, prediction markets like capture price recession risk at a low 5.9%. Yet, high interest rates create severe friction for SK Hynix as its multi-billion-dollar memory fabs hit their capital-intensive build phase. On the policy front, trade friction and sector-wide passive capital flows are violently repricing semiconductor equities. The SOXX index plummeted 5.7%, dragging hardware suppliers down in an automated liquidation cascade. Escalating tariff threats from Washington introduce immediate cost friction into international hardware supply chains. Crucially, institutional capital flows are being distorted by passive index inclusion mechanics. As global semiconductor assets are evaluated for major benchmark additions, passive index vehicles like SKHY, and tech-focused funds like QQQ exert immense structural force. When a hardware stock triggers passive inclusion criteria, index funds are legally mandated to execute billions of dollars in market-on-close purchases within a strict 10 to 15-day window before the effective date. This creates massive, artificial price momentum regardless of underlying silicon yield or margin degradation. But when broad macro sentiment turns, those same automated rebalancing algorithms trigger forced, mechanical selling. That structural flow amplifies single-day drawdowns, converting minor sector headwinds into violent, single-day valuation collapses. Geopolitical conflict and customer architectural pivots are intersecting to dismantle SK Hynix's pricing power. Geopolitical friction is no longer an abstract risk. It is a physical constraint on cross-border silicon delivery. South Korea sits at the exact fault line of the US-China technology war. Export controls and regional supply chain threats force memory manufacturers to duplicate production footprints, eroding gross margins across every wafer produced. Simultaneously, the physical constraints of AI infrastructure are forcing customers to alter their hardware blueprints. This customer-side architectural throttling strikes at the core of SK Hynix's growth engine. Counterpoint research data confirms SK Hynix's HBM market share has already eroded from 69% down to 58%. Over the exact same period, Micron expanded its second quarter DRAM revenue share to 25%, closing within just 1 percentage point of SK Hynix at 26%. SK Hynix is paying peak capital expenditure costs for fab capacity, right, as its primary customer reduces the physical HBM stack density per accelerator rack. Social and political signals are compounding this pressure. Public backlash against big tech's immense energy and at the lab, we trace every dollar of hyperscaler infrastructure spend straight to the silicon bottleneck. Last quarter, total hyperscaler CapEx hit $110.8 billion, with Google Cloud deploying $44.9 billion, Azure spending $35.8 billion, and Meta investing $30.1 billion. That massive cloud deployment demands high-bandwidth memory for next-generation AI accelerators, directly driving SK Hynix's 256.8% revenue surge as the primary supplier for NVIDIA's AI architecture. SK Hynix reported earnings per share of $56,670, beating the Wall Street estimate of $39,952.12 by 41.8%. A solid beat that signals strong execution. The lab tracked 4 consecutive quarters of earnings beats for SK Hynix, averaging a 24.5% surprise. The company crushed Q1 2026 estimates by 41.8%, posting $56,670 against the $39,952 projection, following beats of 14.3% in Q4 and 39.4% in Q3. Management systematically sandbags guidance, but today's 8.24% drop shows the market is ignoring the operational streak and punishing broader memory supply concerns. SK Hynix memory is trading below its 20-day average at zero. Management's headline pitch in their recent registration filing centers on total market dominance as an AI memory semiconductor titan. Look closely at their IPO prospectus filed just 39 days ago. The word semiconductor appears 451 times. That aggressive corporate framing is paired with a headline-grabbing announcement, approving $38 billion toward building new memory fabs, specialized cleanroom manufacturing facilities where microchips are processed on silicon wafers. This PR strategy aims to project total structural confidence. Management wants the market fixated on their $26.2 billion in net offering proceeds. They want you to ignore the multi-year physical delay before those new cleanrooms produce a single commercial chip. No qualifying executive statement in the last 6 months clarifies this operational timeline, forcing us to read the SEC disclosures, filings mandated by the Securities and Exchange Commission to expose hidden corporate risks. That level aligns with its 42.8% historical baseline. Meanwhile, retail sentiment on investor forums reaches 72% bullish. Individual investors are aggressively buying stock dips, assuming memory pricing power will never soften. Because the stock listed roughly 39 days ago, institutional 13F holdings, quarterly regulatory forms that reveal institutional portfolio positions, represent a data gap that mainstream financial commentators are blindly misinterpreting. What management is saying is that $38 billion in upfront capital expenditures guarantees endless market power. What the lab hears is an executive team committing record capital to new facilities at the exact top of a cyclical memory expansion. While financial media highlights a four-quarter streak of EPS beats, earnings per share, calculated as total net income divided by outstanding stock, with a recent plus 41.8% surprise, the underlying market share metrics show structural friction. Independent data from Counterpoint confirms that SK Hynix saw its HBM market share, high bandwidth memory, the vertical 3D silicon stack integrated into AI accelerators, slide from 69% down to 58%. In overall DRAM, dynamic random access memory, the primary system memory inside computing hardware, total revenue share dropped from 29% down to 26% in Q2 2026, according to IDC. Their technical execution in next-generation HBM4 packaging remains impressive, but primary compute customers are actively modifying their hardware architectures. TrendForce reports that lead accelerator clients are trimming physical HBM configurations on upcoming chip platforms like Rubin Ultra to manage total system costs. Squeezing memory density per server directly compresses unit shipment volume for the primary hardware supplier. SK Hynix is building massive fab space to support memory configurations that major customers are already downsizing. Watch the specific line item for gross margin alongside memory market share disclosures in the MD&A, Management's Discussion and Analysis, the section of financial reports where executives detail operating performance. Set your calendar reminder. The momentum breakdown for SK Hynix. RSI sits at 62. Pointing to bullish momentum, with buyers in control. MACD is currently bearish, with downward histogram pressure, raising $26.5 billion in its offering at a $149 offer price across 177.9 million shares. The firm established significant capital balance to fund next-generation fab improvements. This technological position grants short-term pricing power that standard commodity memory producers cannot replicate. However, that Moat faces immediate physical and geopolitical friction that consensus models consistently miss. Strict U.S. export controls prohibit SK Hynix from importing advanced chip-making tools into its key manufacturing facilities in China. This regulatory wall physically freezes process node upgrades across nearly half of its standard DRAM. Dynamic random access memory, the volatile semiconductor memory used for active compute tasks, production capacity. Simultaneously, Samsung and Micron are aggressively scaling rival chips to contest SK Hynix's primary supplier status. With global demand for smartphones and laptops softening, unallocated standard memory risks flooding the spot market, applying severe pressure to overall gross margins at the exact point in the cycle where trailing P/E, price-to-earnings ratio, a metric comparing current share price to historical net income per share, stands at 20.8x against a forward P/E of 4.8x. Here is the single question a senior semiconductor analyst or hardware engineer asks behind closed doors. Can SK Hynix defend its premium margin structure while nearly half its physical manufacturing base is legally blocked from tool upgrades and primary customers seek multi-vendor redundancy? The lab's answer is an emphatic no. Mainstream financial commentary treats high-bandwidth memory as an isolated growth engine, but physical silicon manufacturing requires high total fab utilization to maintain profitability. When export restrictions choke capital equipment imports into Chinese facilities, mature node unit economics degrade rapidly. As competing vendors achieve qualification and split memory allocation, SK Hynix loses the pricing leverage needed to absorb legacy fab inefficiencies. From a technical context, a daily RSI, Relative Strength Index, a momentum indicator measuring the speed and change of price movements on a 0 to maximum scale, of 62.8 aligns with a bearish MACD. Moving Average Convergence Divergence, a momentum indicator tracking the relationship between two moving averages. Furthermore, Trading volume has dropped 25.9% below its 20-day average, signaling fading institutional participation as the stock tests moving average support near $XXX within a broader chart pattern bound by $YY support and $ZZ resistance. The lab's evaluation resolves into two time-bound business scenarios over the next 2 quarters. If accelerating volume from Samsung and Micron forces price concessions, while weak consumer device demand depresses standard drum unit revenues, it reveals that specialized AI memory exposure cannot insulate total earnings from broad commodity down cycles. The single definitive data point that will separate these outcomes is legacy DRAM gross margin trajectory prior to the company's 180-day IPO lockup, a contractually mandated holding period preventing insiders and underwriters from selling shares. Expiration, when 177.9 million shares enter the forward supply outlook. The lab assigns SK Hynix a Moat durability score of 64 out of XXX, reflecting clear packaging leadership impaired by severe geopolitical tool restrictions and intensifying competitive convergence. Here's the macro picture shaping SK Hynix. Strict U.S. export controls prevent SK Hynix from importing advanced chip-making tools into its large manufacturing facilities in China. This limits the company's ability to upgrade nearly half of its standard memory production, threatening its long-term profit margins as trade tensions and potential new tariffs escalate. SK Hynix dominates the artificial intelligence boom by stacking memory layers like a high-rise building to deliver fast data directly to NVIDIA's processors. However, Samsung and Micron are rushing rival chips to market, forcing SK Hynix to spend heavily on manufacturing improvements to defend its top supplier status. Over the next 6 months, the main opportunity for growth is the full-scale shipment of its advanced 12-layer memory chips for NVIDIA's new Blackwell hardware. The biggest risk is that weak global sales of smartphones and laptops will flood the market with unused standard memory chips and force prices down. SK Hynix operates at the absolute peak of the AI memory build-out, capturing 56% of the high-bandwidth memory market and anchoring NVIDIA's Blackwell architecture. In its prospectus, management frames the business purely as an indispensable AI computing powerhouse, but the underlying mechanics tell a dual story. Commodity memory cyclicality remains exposed to weak consumer electronics, while massive $37 billion fab commitments lock in heavy capital intensity. At the lab, our verdict indicates peak margin extraction over the next 2 quarters, after which escalating competition from Micron and standard drum inventory risks will test structural durability. SK Hynix just tipped its 1-alpha drum yield curve. This is the margin inflection Wall Street keeps missing. Which engineering constraint most threatens SK Hynix Inc.'s moat? Give us your evidence. This isn't financial advice. We're engineers, not brokers. Markets change, yields slip, and past performance never guarantees future results. Always run your own numbers before pulling the trigger. Hit subscribe so you don't miss the next Die Shrink deep dive. If you want our full breakdown on NVIDIA, the link is in the description. Stay sharp in the lab.